Knowledge is power. Make an impact by learning more, or hire us to do it for you. Let us focus on what we do best so you can stay focused on what you do best. Find all of our options under services, one-to-one training, subscription-based training, or accounting and business consulting.
Most companies fail. Actually, I shouldn't say most companies fail. 50% of all companies fail within the first 5 years. If you do a Google search or ask Siri or whatever, how many businesses fail within the first 5 years, and you get the exact response that I got when I did it, here's what it says. It is often said that more than half of new businesses fail during the first year. According to the Small Business Administration, this isn't actually true. The SBA, or Small Business Administration, states that 30% of new businesses fail during the first 2 years of being open, 50% during the first 5 years, and 66% during the first 10. So only 44% of companies make it past the 10-year mark. Why is that? A colleague of mine recently, and a little bit to my surprise, asked me why all this emphasis on cash flow. Well, what I'm going to prove to you in the next couple of minutes here is that cash flow is the one thing that will make the difference. More than any other thing, cash flow will make the difference between whether or not you can stay in business. Take, for example, a scenario in which I'm not showing profits, but I have enough money in the bank to meet my obligations. I can pay my payroll. Where that money came from isn't necessarily important in the moment, right? What matters is if I have the money to meet payroll and to pay all my other expenses, I'm in business regardless of whether or not I'm profitable. On the other side, if I'm very profitable, but I have no cash, and there's a number of reasons why that can be, and I'll explain, but if I'm very profitable but don't have cash to make payroll, and I can't borrow money to cover the gap until I collect whatever is owed to me, then I'm out of business tomorrow, overnight. As soon as I can't make payroll, all bets are off. So cash flow is the key. Without cash flow, I can't be in business. If I have cash flow, regardless of whether or not I'm profitable, I can stay in business, at least for a period of time. Now, what are these scenarios? Well, take, for example, a situation in which I have a lot of profit, but it's not being collected. I have accounts receivable, right? So we want to look for holes in cash flow. Where could cash get locked up that even if I'm profitable, I still may have problems with cash flow, right? One of them is just that, getting locked up in, having your cash locked up in uncollected accounts receivable.
Having cash tied up in uncollected accounts receivable is a common thing that messes with people's cash flow, but there's an easy way to fix that. First of all, you have to monitor it. Using cashflowtool.com, you can connect to your QuickBooks Online company or your desktop company, and you can get the data. You can look at this right here where it shows me average days to collect from customers. If 50 days seems like a lot, we can start making phone calls and see about getting our customers to pay us a little more timely.
Another one could be the accumulation of inventory. I'm buying all this inventory, and if I'm buying more inventory than I'm selling, that's negative cash flow. That can hurt my cash flow, and especially if I can't eventually sell off all that inventory, I'm running the risk of obsolete inventory that will have to get written off, and I'll never see the money for it. So inventory is a big weakness potentially, and a very important area when I have a company that sells inventory, where that's the lifeblood of the business. That cash flow is critically important there.
If cash flow seems tight and you think it might be related to inventory, then you want to look at average days of inventory. And this number 13 might seem unlucky. It might also seem really good for inventory, and it may not be. It depends on your industry. And most importantly, when I'm working with clients on this stuff, I always encourage you to compare you to you, right? So look, what has happened to this number over time? Has it gotten better or has it gotten worse? In this case, if the bigger the number gets, the worse it is. It means the longer it takes to sell an item of inventory after it's been bought and placed on the shelves. So inventory turnover is an important metric to look at to monitor cash flow and make sure that we're not locking up too much cash in inventory. Granted, there are times like the holidays, for example, where it may be normal to stock up on more inventory, which means you might increase your inventory turnover days, but hopefully you won't. Hopefully if you're stocking up, it's because you expect to turn over more inventory in the same period of time to which you're accustomed.
Any other asset, if I see an asset on the balance sheet that month over month is accumulating, that's a potential red flag. That means money's being locked up into something. It could be that I'm my business, and I have this going on with one of my real life clients where they're investing a lot of money in another company. So that asset on their balance sheet that represents their investment in that other company keeps growing. That's cash being tied up in something that may not be liquid. They may not be able to get that money back very quickly. So if their core business gets into trouble, again, they can end up going out of business even if they're profitable because they're using up a lot of their working capital to go into this other company. So any increase in assets. The other thing is if there's a lot of liabilities on the balance sheet, if we have a lot of debt, and of course we have to take a closer look at the terms of that debt. Maybe we have a lot of debt, but maybe these are loans from friends or colleagues where we don't have to pay it back right away, in which case it doesn't have an immediate negative impact on our cash flow. But we do have to be aware of it, and as an accountant I have to plan for that and say at some point we need to have enough money in our profits to pay off this debt, because at some point that debt's going to get called in, right? At some point whoever loaned us that money is going to want to get paid back, probably with interest, right? Or maybe with some kind of a return based on a share of the profits. Whatever it is, we're going to need cash to repay them. That's the point. That's why cash is king. That's why cash flow is the most important thing in a business.
What I've been showing you are pieces of what we call speed of cash in cashflowtool.com. This refers to how long does it take from the minute I put $1 out there to pay for something, how long does it take for that dollar to come back to me in the form of revenue from something I've sold? Right? And so these are all cards, if you will, that give you important piece of information that help you understand your speed of cash for your company. Things like the working capital. One of my favorites, though, is days cash on hand. This essentially tells you if you have no more sales based on the money you have in the bank today, how long it will last. So this is something you want to keep an eye on. If this number starts shrinking, we've got problems because presumably we will have more sales. So this number should stay fairly stable. If it doesn't, it could mean we have a problem, or it could mean things are getting better if the number increases, right? So you have the speed of cash, and then don't forget you have other areas. The executive summary. Here you have every possible card that Cashflow Tool offers, and they're constantly adding to this and updating things. And then you can create your own dashboard to look at the specific things that you'd like to look at that are important to you. And remember, this stuff is much more useful on a comparative basis. So you want to be looking at this stuff today versus yesterday. And that's why I love that they give you the comparatives monthly on some of these things, right? So 53, our average cash gap has gotten worse in this case as of November over the previous month in October, right? So, and these are things that we might want to look further into or not. That's the point, is to look at this first and decide what do we need to look further into. And then we can start doing our research and digging in a little deeper to find out what's going on. The point is to catch problems early and correct them before they become big problems.
With cash flow, you can stay in business. Without cash flow, you are out of business, period, dot, the end. So cash flow is important. Pay attention to it.